Hello and good afternoon, everybody. Thank you very much for joining us at our Sydney Investor Day for 2019. I see many familiar faces here, but for those that don't know me, my name is Steve Bennett and I head up the direct property business at Charter Hall. As per usual, what we like to do at these things, we'd like to do two main purposes. We'd like to give you an update of the funds that many of you are already invested into. But first and foremost, we want to educate you. We want to give you updates on the market. We want to give you updates on key property trends so that you can make more informed decisions going forward and understand what I passionately believe is a fantastic investment class and that investors should consider more in their portfolios. The agenda today, just following that, I'm just going to give a very high-level overview on the direct business. I'm then going to pass over to David Harrison, the CEO and Managing Director of Charter Hall, to run through where the group is, where the manager is that manages these funds. And then we have Selena from Ernst & Young, who's a true property expert in terms of the trends that are happening, and she's going to run through how much data is driving the use and trends. And it's very important for groups like Charter Hall to listen to experts like this because it does influence the investment decisions, how we lease up assets, the kind of developments we do. And then you hear from David from Jones Lang, who'll give you an overview of the market. So he'll touch on what's happening in the office sector, the ever-booming industrial market, which, as I said last year, we thought was a very key sector. The thematic around that and e-commerce has only strengthened over the last 12 months. And then I'll provide an overview of the funds and then open it up to Q&A for any questions. This basically just says I can't give you financial advice. Everyone here is just providing information. The funds have been doing very well. I'm pleased to say that over a long period of time, the Charter Hall Direct suite of funds, when Cedric was first in the business, through to Richard managing it, and now myself, has continued to perform for investors over a long period of time. So the grey section there is our closed for investment, funds that we've raised money for, managed, and since returned the capital. The closed funds are funds which we're still managing the assets on your behalf and paying you regular, either monthly or quarterly distributions, but are no longer open for investment. And the ones on the far left side are still open for investment. And what we've done over the last few years at Charter Hall is we've moved the business model to open-ended funds, which are available for investors whenever it suits you. And we've introduced what we term just rolling 5-year liquidity events. So we've done that because we know the feedback from most investors when we hit these review dates is, well, how do I stay invested? So we're making it an absolute choice for investors on that front. The direct team, it's a relatively small team in the 550 odd people that are in Charter Hall, but it's a team I'm very proud to be associated with. We've been together for a long period of time. We've won some fantastic external awards from external research houses. And I don't put that up to say what a great job I'm doing. It's really a reflection of the direct team and the wider Charter Hall Group's contribution to these funds. And ultimately, we're getting these rewards because they're recognising the results that we've been able to deliver for the investors in these funds. For this part of today's presentation, I'm going to try and do 3 things, and I'll try and keep it brief. If I don't touch on something that you want more information on, please just come and ask me later. I will be hanging around after as well as the other team members. So I'm going to give you an update on our closed-end syndicates, where they're at, the unit prices, the returns, the vacancy, the occupancy. But I'm firstly going to run through our 4 open products, 5 if you include the new listed property securities, which we picked up as part of the Folkestone acquisition. And then I'm going to spend a little bit of time on 2 funds in particular, one closed and one open, the Direct Industrial Fund number 2 and the Direct Office Fund. And the reason why I'll spend a little bit more time on those is they have their major liquidity events coming up. So I want to explain to you the differences in how they operate and give you a feel for the kind of choices that you'll have as investors, many of you in those 2 funds. So the first fund I'll talk about is the PFA. It's a fund I'm very proud of what we've done here. We took over this portfolio and took over the management rights back in August 2012. At the time, it was a very diversified, and I'm using that word quite generously in this case. It had an eclectic mix of assets without a common strategy binding that fund together. We took 5 years to simplify that fund strategy, sell assets where we thought the value had either been maximised or that there was further downside risk. We lowered the gearing, which was approaching 60%, back towards the more 30 to 40% level, which we're comfortable with at Charter Hall. And in the last few years, we've successfully acquired additional assets, which are very much in line with the Charter Hall thematic of long-term leases, high occupancy rates, and fixed rental increases built in. And you can see here over the last 3 years, the funds have done a little under 12% per annum. The next open fund I'll talk about is the Direct Industrial Fund number 4. Creatively named 4 because it follows 3 other closed-end industrial funds. This fund will continue to grow. I want this fund to be like a large direct office fund. I think there are very strong reasons to having diversification and bigger portfolios in the current climate. You heard from David before, forecasting is very difficult. What I've learned from Cedric in particular early in my career, that it's inherently impossible. So what you can do is try and take as many of the known risks out of portfolios as you can, and not having exposure to a single asset or a single tenant can drop the risk profile of that particular investment. So what you do get in an industrial fund, which is a little bit different to the office assets, is you get longer term leases in place. You can see here a very well diversified fund, a little under 350 million. We've just signed a new asset down in Melbourne as of yesterday, which will push that portfolio value to around $370 million. It pays quarterly distributions, and it's really leveraging off that thematic with logistics and industrial being a growth sector, not just now, but into the future. I read an article in yesterday's paper, Blackstone, the largest owner of real assets, so property being a real asset in the world. They manage $720 billion of assets across the globe. They just bought a $25 billion industrial portfolio. And one of the senior leaders of that business is on record as saying, we believe logistics is a growth sector and it's our highest conviction thematic across the whole company. So that's what the big end of town are doing. That's what the very sophisticated investors are doing. And they're actually putting their large checkbooks where their money is, where their mouth is as well. Here is a short video of one of the most recent acquisitions by that fund, the Direct Industrial Fund number 4. It's located in Prestons in Sydney here. For those that don't know that market, it's Western Sydney, just off the motorway, fantastic location. Being close to that infrastructure is critical for industrial. The rent piece of the equation, typically for a tenant does vary, is around 5% of their cost base. If you look at the logistical costs of unloading the goods, shipping the goods between the venues, that's 10 to 15%. So having the real estate located in the right locations is a much more important decision than the rent. So this is a new facility. I like new facilities, very low capital expenditure. And it benefits from having a high quality tenant in there, being Mainfreight, a logistics provider, and they signed up to a little bit over a 10-year lease, meaning I don't have to worry about downtime, I don't have to worry about vacancy, I don't have to worry about spending some significant amounts of CapEx upgrading that property. And ultimately what that means is it gives me more certainty in the distributions that we can deliver to investors into that fund. Our fourth of the most recent unlisted funds is the Diversified Consumer Staples Funds. Some people have picked up that they thought it was heavily weighted to the retail market. What I would say is that we're repositioning that fund to focus on the healthcare market. We have 2 assets that are in due diligence at the moment in that healthcare space. You've just heard around the trends in what's going to happen in the demand for those services. It means that the users of that space will be particularly sticky because their businesses are forecast to continue to grow and continue to be strong. Means they can continue to pay the rent. And so over time, what you'll see is a larger proportion of this fund not only focus on that non-discretionary consumer staples element, but it will move and transition towards that healthcare market. And finally, the last open fund is the Charter Hall Maxim Property Securities Fund. We're very fortunate in that we picked this up as part of the bigger Folkestone acquisition. This is a liquid product. It invests in listed real estate stocks. I'm not an expert in that space, and nor is my team, but we have there an in-house capability now because we've got the whole team that was managing that, and that fund's been highly rated for a long period of time by external research houses. But something you should be aware of, whilst listed does provide that benefit of liquidity, and that can be a key driver for many investors, as opposed to the unlisted funds, which by their very nature are more like a term product where you should think of it as a 3 to 5 year investment term. Because it does invest in underlying stocks that are traded on the ASX, it does tend to have more volatility. And again, I just encourage you to think of all property, whether it's through a listed holding such as the Maxim Fund or the unlisted funds, you should be thinking about it around that 5 year investment term. In terms of the closed-end syndicates, so these are syndicates that we're still managing, but which are not open for new capital. What I would say here is that they've continued to do what they said they would. High occupancy, in fact, they're all 100% occupied. Long-term leases in place. The shortest there is leased to Coles Adelaide at 7.9 years. We are liaising with Coles to try and extend those leases out, not just for this asset, but another Coles asset in Perth and one in Melbourne. We're very fortunate that we've got a very strong relationship with Coles. We're actually their #1 landlord in the whole of Australia. And that's because we have them in not only our industrial properties where they have distribution centres, but your more traditional retail centres, and we have their head office in Melbourne as well. The other two types of investments, the BW Trust, we recently extended the leases by 5 years, a good example of active management. So not sitting there saying the lease terms are now 7 years, that's pretty good, plenty of time, we can sell that on and give investors their money back. What we did was we actively negotiated to extend those leases back out with Bunnings, and we simply put to investors, what would you like to do? You can continue in that fund, or if you'd like to redeem, we've got plenty of investors that would like to acquire units, and that fund has rolled for another 5 year term. And the Direct Automotive Trusts, who have as their key anchor tenant, AHG, Automotive Holdings Group. For those that are across the financial press, they're subject to a takeover offer by AP Eagers. What I would say is from a landlord's point of view, that's fantastic. You hear me talk a lot about income security. That's what I know many of you have invested in these funds for. Secure income streams that pay out capital to you, the income to you over monthly and quarterly periods, and which will grow over time. So I'm looking at AHG, and they've got a market capitalisation as of yesterday of $930 million. AP Eggers have a market capitalisation of a little shy of $1.95 billion. So put them together, my covenant strength has just improved, meaning that that business is even better positioned to continue to pay those rents for the long term. Equally, through the industrial team and Richard, we've got very good insights into those both tenants. And so we're already engaging with them to understand what their property needs are into the future. Again, trying to understand whether we should sell assets early, should we extend leases, and make sure that we're developing a strategy that suits the tenants and ultimately delivers the investors the best returns. The other industrial funds, I've already talked about Div 4, so I won't touch on that anymore. But the Direct Industrial Fund number 2, I will spend a few minutes on shortly, and that's because it does have its liquidity event coming up. And the Direct Industrial Fund number 3 still has a number of years left to go, and that's doing exactly what it said it would do, continue to grow distributions for investors. I've had a number of investors ask me what's happening with distributions going forward. Unfortunately, it's a little bit too early in the year for me to give that information out. What I would say is the team are going through a detailed process of building up property by property to the fund level. The team are pulling that together, and ultimately I'll need to make a recommendation to my responsible entity board. But for the majority of funds, what I would say is that the income and distribution rate is expected to increase from 1 July onwards. So Div 2. When we first launched this, there was just 2 assets in the fund. Investors trusted us as a manager that we would deliver on the investment mandate, that we would only acquire assets that we said we would, and I'm very pleased to say we've done that. Even though this fund has been running for almost 6.5 years, the weighted average lease expiry is still over 10 years. So it gives you an idea of not only the length of leases you can get from industrial and logistics, but combine it with the active management that Charter Hall does, where we engage with tenants, we engage with them early, and we try and continue to extend the lease terms out well in advance of those expiries. So what did we actually do in a bit more detail when we did Div 2? Well, as I said, we built out that portfolio to $288 million now. 3% fixed rental increases average across that portfolio, meaning that the distribution rate has grown over time. We diversified the portfolio and we actually focused heavily on the eastern seaboard. We saw that that was the market where we thought had the best growth opportunities at that time, particularly relative to the price that we could acquire those assets. So the risk-adjusted returns look great, and that's what we delivered in terms of where we put the money. We actively manage the portfolio. So I just said we try and extend leases. And so what we did here is we had a situation where the key tenant at 2 assets, when I say key, it's probably an understatement, the sole tenant at 2 assets actually went into insolvency. So Arium, everyone saw the headlines, the big steel group blew up. Not because of the use that they were using in these sites, but largely because of the Whyalla steel mill, which was a big albatross around their neck, which was dragging the whole group down. So what we did was we actively engaged first with the liquidators and the administrators, and then quickly transitioned that to the Gupta Group, who were the front runner to acquire that business. What it meant was ultimately we extended the leases at both sites by 5 years, so 5-year lease extensions, but that's no good if your tenant's not going to be around. We dug through all the financials of the acquiring entities and we extracted some bank guarantees as well. So we understand that we're the only property group who managed to negotiate those bank guarantees with that incoming tenant. To everyone else, they just said, no, take it or leave it. And yet we were able to get a more secure position for our investors through that process. We actively manage the portfolio. So at Charter Hall, we're not an accumulator of assets. If we think an asset value has peaked or that there's nothing else we can do, we're happy to sell it. We had, last time I was up here last year, we talked about the Toll Rockhampton asset. We thought that was probably as good as it was going to get for that particular asset in that location. We sold that at a premium to book value and we returned the money to investors. Ultimately, if we give a good return, we would still rather give the money back to you and you can make the decision on where you want to put it. And that's a key point because that cuts not across just Div 2, but the rest of the portfolios that we manage as well. So what we're looking to do for Div 2's review event, and I want to compare and contrast this to what I'll be saying shortly on the direct office fund. So this fund was set up as a fixed life fund. So at a particular time, it would end. That's very different to the 4 open funds, or 5 if you count Maxim, that I talked about earlier. What they have is rolling 5-year events. So every 5 years, investors are provided the ability to get their equity back. With this fund, it was set up as fixed life. What the PDS did say was that we could extend it or make a recommendation to investors to extend it for 3 years if we thought it relevant to do so. And having now had the opportunity through myself, Ross, Scott, our investor relations team, Marco, we spoke to many investors who have said, Stephen, this fund still has a 10-year whale, it's fully occupied, and it's doing what we say it would do, which is providing that long-term income stream. So we don't want to sell. So we're going to give investors the ability to choose what they want to do. We'll simply write to you, and if people want to exit, that's fine. We'll be able to source replacement equity for that. The ongoing distribution yields around 7%. So again, very attractive, particularly in a low yield environment which we operate. But in the event that we did get more than 50% that want to redeem, we would look to wind up that fund or find a buyer for all the units. What I would say is we've been through many events like this historically, and typically the amount of people that want to redeem from the strongly performing fund is around that 15 to 20% level. So that's what I'm expecting. If you're in that fund, the expectation is that it will continue on for another 3 years, but of course it is subject to what ultimately investors tell us they want to do. And you can see here graphically, I'm a very visual person, I like to see things in graphs and charts. You can see here the income and distributions have grown over the term of the investment, even though we sold a property. So we sold a property, we're getting less income, we've returned that capital to investors, and yet we still managed to grow the income stream primarily because of those fixed rental increases which come through. You can see here a drop in the unit price. It's not a drop in the traditional sense. It's simply because when we sold that asset, we gave the money back to the investors. And that's how we show it. We used to show it grossed up, but then people would get confused saying, well, Stephen, it's actually not $1.34. You tell me it's $1.26. Here's another short video, not because I'm being a lazy presenter, but because you heard earlier, real estate is a tangible asset. And one of the key advantages is you can see what's happening at our sites. Last time I showed you some external footage from the outside of this Woolworths distribution shed. It's a 20-year lease to Woolworths, $200 million we paid as a group, Charter Hall. Woolworths has spent over $300 million internally on the automation there. So what I would say is here, even though that you see lots of people in this video, this is a Woolworths produced video, I suspect that's not an accident. Because of all the automation, the amount of people that they actually need to run that site is significantly down on what it used to be. So you'll see here the conveyor belts, the internals. Really, people don't need to touch the goods in that shed except to unload it off the first truck that drops it off and reload it. There's autonomous robots throughout that property, and the only picking that they do is for unusually shaped objects. And which brings me to our last fund, which I'll talk about, the Direct Office Fund. It's probably our flagship fund, not just because it's the largest, but because it's been around for the longest. It's now over $2 billion. It jointly owns assets with many of our wholesale vehicles, has a long-term lease structure, particularly for an office fund, at 8.6 years, and it also has its review event. So this fund, being an open-ended fund, has its liquidity event in December, but this fund will definitely continue. So it just happens every 5 years. This will be our third liquidity event we've managed for this fund. We know what to expect. We've positioned assets for sale, which we want to move on. We're running a very low gearing strategy of this fund to make sure there's capital there. And we're also talking to new equity investors who want to get into the fund. So this is very simple here, what we do. We simply write to investors and we ask you what you want to do for your individual holding. And it goes from everything, whether you want to stay invested for another 5 years, your choice. If you want to partially redeem some holdings, again, that's your choice. Or if you want to redeem the full amount, that's absolutely fine as well, because ultimately we want investors in our funds that want to be there for the long term. And again, there's not much more to say on this other than you can see here the same sort of story with the indirect industrial fund. Distributions increasing over time and the share price as well. And look, I'm running a little bit out of time. We're running a little bit behind today. So look, I could talk about this fund and all our funds all afternoon. There will be questions inevitably, particularly if you're in DOF and DIF2 around the review event. I do encourage you to ask any of the team members that you see here. We will make ourselves very available. And finally, before I open up for a short period of Q&A, what I would say is this is a good example of the kind of assets which we've bought in the last 12 months across our suite of funds. A 10-year lease government property, the first one there, owned by DOF in Brisbane. We like the Brisbane thematic. We like the risk-adjusted returns. We like the fact you can buy this at a 6% cap rate instead of a high 4%, which you would if it was in Sydney or Melbourne. The Main Freight large distribution centre, which was the video I showed you earlier, acquired by DIF4. And more recently, the 10 Shelley Street down at Barangaroo, one of the few freehold properties in that precinct, benefits from a long-term lease to a high-quality tenant covenant in Suncorp. So look, that is a quick run through. By definition, it needs to be pretty quick. We've got 10 funds to try and get through in a very short period of time. And as I said at the start of today's presentation, the aim here isn't to promote our products. The aim is to educate you as investors. We want you to know where the markets are, what the trends are. And so look, I will throw it open and I will invite our two guest speakers just to the stage. Is there any online questions? Okay. Do you see space optimization technology driving reduced office space demand? Well, I'm going to pass that straight through to you, Selena. That seems right up your alley.
Yes, look, it's interesting. Without a doubt, the space demand is compressing. If I again just take EY as an example, we know that over the last several years, we grew our employee numbers by 25%, whilst at the same time we moved, this is in Sydney, from 680 George Street down to 200 George Street, and we managed to compress down about 50%. So we are working in, as I sort of said, we've gone from offices to everyone just having open plan hot desk situation. So I do see that compressing, though what I think we're seeing is also different types of space. So people that may have traditionally just worked from home or worked in non-traditional formats, actually coming in and using space in the likes of sort of WeWork or co-working locations. So I think whilst we're seeing space compressing by some of the large employers, there are freelance and gig style workers that may not have worked in offices before that are now starting to come and work in some of those spaces. The technology point's a really interesting one. It's still emerging, I would say. We do some work on that ourselves, and we're still trying to find that holy grail of getting the technology that really genuinely, accurately assesses that. I think we could see some further compression as that technology gets better.
Thank you. All right, David, I'll throw the next one to you, which is what do you think the long-term impact will be on retail property with a trend of online purchasing continuing?
I think your first impact is really on tenancy mix. I think there's no doubt that you're going to see strong growth in certain types of retailing, probably weaker growth or even contraction in other types of retailing. I wouldn't underestimate the capability and the capacity of shopping centre managers and retailers to adapt and adopt. And given that we are sort of 5 or 10 years behind the United States, for example, and a lot of other countries, I think there's a lot that we can learn from a retailing perspective in terms of what you can do to deal with the impact of IT. I think we're seeing retailers here, for example, the department stores, putting significant investment in getting their own websites organised, so that it's not going to be an either or. Either you're an IT retailer or you're a physical retailer. I think you're going to see a lot more retailers deal in both spaces, and we are seeing some IT online retailers looking to find physical space, because people do actually want to see what they're buying before they get it, especially for significant items. So I think it's a flexible position. I think there's no doubt that the retail sector is going to have to change quite significantly, and I think you'll see some relative values change between different kinds of retailers. Right now, even if you take, for example, the regional sector or the neighbourhood sector, the difference between weak centres and strong centres is very significant. There's a wide range within each format between the sectors that are doing well for demographic reasons, for tenancy mix reasons, for property management reasons, and the centres that are doing badly. So I'm sorry, it's a rather imprecise answer, but I think you really got to take advantage of the changing scenarios which are emerging. But I'm pretty confident that you'll see significant responses from the retailers themselves.
The next question I'll take myself, which is, will you be launching any new open or closed-ended funds? The short answer is no, nothing is planned. And I'd say that for mainly one reason. I think that the bigger diversified funds have a number of scale benefits over launching a new fund at the moment. And it doesn't mean we won't ever do a new one. It just means that between 2 office funds, an industrial-focused fund, a portfolio weighted towards consumer staples, and now a listed property securities fund, we think we've got most of the key sectors covered, and that larger funds benefit from having had the ability to amortise the cost of stamp duty already over a long period of time. You get scale benefits because your cost of debt is cheaper when negotiating with the banks. They see the bigger funds as lower risk. And you also get scale benefits in terms of providing liquidity. It's much easier to sell off 1 or 2 assets than it is provide any liquidity if you've got a 1 or 2 asset syndicate. So that's the answer. Never say never, but it's a question I get asked a lot, but there is nothing imminently in the wings. So look, with that, I might finish up today. I'd like to, again, thank our speakers for spending their time. I know they're both extremely busy, so please just give them another round of applause. Thank you.